We finished the operating activities. It's time to move on to the next section, which is the cash flows from investing activities. So in the statement, it'll start out with exactly that line. Cash flows from investing activities. And as we saw earlier, when we're talking about investing activities, we're specifically talking about changes in different long-term asset accounts. So as I look at my balance sheet here, this is my asset section. I already checked off accounts receivable and inventory, those current assets. The only two long-term assets that I have that I need to worry about are trucks and accumulated depreciation. Now, the approach that I like to take when I get to the investing and financing activities section, and it works every single time. All right, I know the book likes to teach you some formulas to use. I'm not a huge fan of formulas. I think formulas don't really teach you, don't really help you understand why in the world you're doing something. All right, so instead, what I like to do is I like to instead use something called T account analysis. So what we'll do is, as you can see back here, I have a couple of T accounts created. I will simply just create a T account for each of the accounts that I have to worry about, each of the accounts that I have to check off here for investing activities. And then what I'll do is I'll kind of think about how these accounts work, and then I'll kind of just fill in some blanks to make sure that I can take a look at and I can say, all right, this account, this is what happened to it, and because this happened to it, here was the impact on cash. All right, so trucks. Let's think about trucks. I know every year if we have trucks, they're going to start with something, right? They're going to have a beginning balance in that account. It's going to be a debit balance because it's an asset account. All right, it's also going to end the year with some sort of balance. All right, so it's going to have an ending balance in this account. All right, then what I want to think about is what would make this account go up and what would make this account go down. So if I think about specifically trucks here, the only thing that's going to increase the amount of trucks that we have on our books, on our balance sheet, would be if we acquire more. All right, so I'm going to say anytime we have acquisitions of these trucks, it's going to make this account increase. I like to say acquisitions instead of purchases because purchases implies that we did it with cash, and that might not be the case. When we acquire these trucks, we might pay cash for it, which then will impact the statement of cash flows, but we could purchase it by signing a note payable, which then wouldn't impact the statement. We could purchase it in exchange for common stock, which again, it wouldn't affect the statement of cash flows at that point. All right, so I like to say acquisitions just because it captures everything. All right, now if I think about when that trucks account would decrease, the only reason that we've seen this trucks or any of these long-term plant asset accounts, whether it be trucks, land, vehicle, building, the only time that these accounts go down is when we dispose of these assets. All right, so I'll say disposal over here. That's going to make this account go down. All right, so disposal would make it go down. Again, I don't want to say selling that asset because again, if I'm saying that I'm selling the trucks, that's implying that I'm getting cash for it. I might not have gotten any cash for it, right? I might have exchanged it for another truck, all right? I might have just been done with it and just scrapped it and not gotten any money for it, all right? So disposal kind of covers everything. Could be a sale, could be a scrap, could be an exchange, whatever it is, I have disposed of this asset. All right, let's do the same thing with accumulated depreciation. All right, so accumulated depreciation, a contra asset account, which means it begins and ends with a balance over here on the credit side. All right, so I'll say it starts with something and it ends with something. Oh, somebody spelled that right, sorry. And it ends with something, right? Now, the only thing that has made accumulated depreciation increase the actual account during the year is when we record depreciation expense. Only thing that increases this accumulated depreciation account. And as we saw earlier, depreciation expense is a non-cash item, all right? So I'll fill in the blank for it, but I know that it won't affect cash. Doesn't have to go on to the statement of cash flows here in my investing activities. All right. Now, as far as decreasing accumulated depreciation, there are in practice a couple of reasons that we would decrease accumulated depreciation. All right, but for us, we've only seen one, so that's the only one that I'm going to put on here. The only reason that we have seen to decrease accumulated depreciation is again when we record the disposal of this asset. All right. So, for example, if we sold a truck, not only do we have to get the truck off of our books, but we also have to get the accumulated depreciation that's tied to that truck off of our books as well. All right, so disposing of that asset affects both the truck as well as the accumulated depreciation from that truck. Okay, so now that I understand how these accounts work, all right, I have a good understanding of these accounts here, how they work. The next step, the next thing that I want to do is I want to just kind of start filling in some blanks. All right, so go back here to your balance sheet. All right, and you know that trucks right here. So here's my 2016 information. Here's my 2015 information. All right, so I know that trucks began the year with 446. So I'll put that here as my beginning balance. And I know trucks ended the year with 500, so I'll put that over here as my ending balance. All right. Now, what I cannot do is I can't just say, all right, 500 minus 446. All right, that means the account increased, so it must have acquired more. I can't do that. All right. I can't just assume that the only difference in that account is from the debit right here, because I could have acquired some and I could have disposed of some. All right. And again, I can't assume that that difference had an impact on cash, right? So when I get to this point with any statement of cash flows, I should have some additional information that's provided for me at the bottom of it. So if I look down here at the bottom of the statement of cash flows here, it tells me here during 2016, item 1 right here, the one highlighted, it says a new truck was purchased for $54 cash, right? A new truck was purchased for $54 cash, right? So what I'm going to do here is I'm going to redo a journal entry that I would have done. I'll do it right above these T accounts right here. All right, so a journal entry. If I purchased these trucks, I know that I would have debited trucks, all right? I'm going to left align that, sorry, and I would have credited cash, right? Debited trucks and credited cash. All right, so trucks would have been debited. It says it was for 54, and cash would have been credited. It says for 54. All right, so debit trucks for 54, credit cash for 54. All right. All right. So if I think about this transaction right here, I like to restructure the journal entry to see if it affected cash, because the only time that I have to put anything on the statement of cash flows is if this item affected cash. So if I look at this journal entry, it absolutely affected cash. You can see right here when I purchased those trucks, I credited cash. All right, so in my statement, under my first item from cash flows from investing activities, I'm going to say that I purchased a truck. All right, it's okay to say purchase now. I don't have to say acquired anymore because I know that it was a purchase. All right, so I know that's what happened. All right, and if I think about the impact on cash, again, if I look back here at this journal entry, I credited cash. So if I've credited cash, that means cash went down. So the impact was a negative 54 on my cash. Negative 54. Okay, so now I can just fill in some blanks, all right? So I know this trucks right here was debited for 54, so I could take that right here and put it into my acquisitions column. All right, so if I look at this account now, 446 plus 54. All right, let me just do some math right here in this cell just to show you that it does equal out. 456 plus 54 equals 500, which matches that ending balance, okay? All right, well, that means there must not have been any disposal, so I can delete that. I don't have to worry about that. So if there's no disposal, it means I can delete it from accumulated depreciation as well. And this was the only thing that affected that truck's account. So if it was the only thing that affected the account, again, remember, this is our giant puzzle. I want to cross off that piece that I just used. I just took care of this truck's account. I just saw how the change in that account affected cash, and I put it over onto my statement of cash flows. All right, so let me just, before I can make sure that I'm finished up with my investing activity section, the next thing that I need to do is just make sure that I can balance out accumulated depreciation. All right, so if I look at accumulated depreciation, it says that it began with 153. All right, there's my beginning balance. This says it ended with 234. Okay, there's my ending balance. All right, I saw that there wasn't any disposal, which means the only difference in this account should be depreciation expense, all right? But I don't want to just subtract those two and figure out what that number is. That would be, that's kind of cheating. That's not what I want to do. I want to actually plug that number in there and verify that balance, all right? So if you remember, we know what depreciation expense is. Depreciation expense is shown to us on the income statement right here. All right, so I know depreciation expense is 81, so I'll fill in that 81 right there. All right, and then I'll just make sure it works. All right, so I'll do the math right beside it. All right, so I know that the beginning balance was 153. I increased it for depreciation expense of 81. That results in an ending balance of 234. So it matches. I know that 81 depreciation expense does not affect cash. That's the whole reason that I had to remove it from net income up in that operating activity section. All right, so I can check off accumulated depreciation. Nothing from accumulated depreciation needs to make the statement of cash flows. It's verified. You can see I've verified both of those accounts, which means I should be done with my investing activities, because investing, again, only had to deal with long-term assets. All right, so that was the only item for investing activities. That means that it's just that my net cash is just that negative 54 number. All right, so it's my net cash. Right, because it's negative, what I'll say is this is my net cash used by investing activities. So my net cash used by investing activities is negative 54. This T account approach will work with any asset that we have, right? For example, if this was land, I could do the same thing. Beginning balance, ending balance, land would only go up for acquisitions, only go down for disposal. All right, if it was something a little bit different, something like, let's say, notes receivable, because they technically fall into this investing activity section, right? That would work a little bit differently. So it would have a beginning balance still, it would have an ending balance still. With a note receivable, the only time it would go up is if I loaned more money. The only time it would go down is if I actually collected some of that principal, right? But you can work these T accounts with anything that you want to throw here into your investing activities. Every single one of them you can make work. You can figure out, you can solve for the difference, and you can see how that difference affects cash using the T accounts and restructuring of those journal entries. All right, the only thing left is to do our financing activity section.